All right, let's jump right into a topic that is, well, a classic for the exam setters, and honestly, a place where a lot of students can get tangled up. We're talking about internal reconstruction. Let's get into it.
So, picture this. You're in the exam hall, you flip open the paper, and there it is, a balance sheet. At first glance, everything looks pretty good. The assets seem solid, share capital is high, and your first instinct might be, hey, this company is doing great. But what if that's the trap? What if that's exactly what the examiner wants you to think, right before you start losing marks?
Because the truth is, that balance sheet could be hiding a serious sickness. It might be bloated with things that look like assets but really aren't. Goodwill that's completely worthless now, old preliminary expenses, and a massive debit balance sitting in the P&L account. This is what we call being overcapitalized. It just means the company's value on paper is way, way higher than what it's actually worth. And that right there, that's the problem that internal reconstruction is built to solve.
So, what's the cure? It's reconstruction. Think of it like performing financial surgery on a struggling company. We're going in to clean house, to scrub the balance sheet clean of all those old losses and fictitious assets, so that it finally shows a true and fair picture of its health. And here's the most important part, the absolute key. We do all of this without liquidating the company. We're not ending it, we're saving it from the inside.
Now, this brings us to the two main paths a company can take when it needs to reorganize.
Now, you've got external reconstruction, where the old company is actually wound up and a new one is formed. But that's not our focus today. We're talking about internal reconstruction, and the biggest difference is right here. There is no liquidation. The company itself keeps going. We just perform surgery on its financial structure, usually by reducing its capital, all governed by Section 61 and 66 of the Companies Act, which, by the way, typically needs a nod from the court.
Okay, so if we're going to perform this financial surgery, what tools do we actually have at our disposal? Let's open up the turnaround toolkit. The first set of tools we find are under Section 61, alteration of share capital. Now, it's really important to get this straight. This isn't about reducing the total capital amount. It's just about changing its form. We can take big shares and subdivide them into smaller ones, or take small ones and consolidate them into bigger ones. We can even convert fully paid shares into something called stock. Let's see how this plays out. Imagine we have 20,000 shares of 10 rupees each. If we subdivide them into shares of 5 rupees each, the journal entry is super simple. You just debit the old 10 rupee share capital and credit the new 5 rupee share capital. But here's the key takeaway, and don't miss this. The total paid-up capital of 1,60,000 rupees, it stays exactly the same. We can also do the reverse and consolidate them. The accounting is just flipped, but again, total capital doesn't change.
Similarly, we can convert shares into stock. But there's a critical rule here. You can only convert fully paid shares. So, if we have 4,000 fully paid shares of 100 rupees, they can become 4 lakh rupees of equity stock. The entry? Simple. Debit equity share capital, credit equity stock. And yeah, you can reverse it too. The stock could be converted back into 40,000 shares of 10 rupees each. Once again, the total capital of 4 lakh rupees constant.
Another tool under Section 48 is basically changing the deal for the shareholders. For instance, the company might go to its preference shareholders and negotiate. Maybe they agree to a lower dividend rate, say from 9% down to 7%, or to change their shares from cumulative to non-cumulative. This just helps ease the future financial burden on the company. The journal entry for this is straightforward. Just debit the old type of share capital and credit the new one. Okay, so far we've just been rearranging the furniture. Now we get to the absolute heart of internal reconstruction. This is the main event, the step that actually creates the fund we need to clean up that messy balance sheet. We're talking about the reduction of share capital under Section 66. Now, Section 66 gives us 3 ways to do this. We can extinguish uncalled liability, pretty rare. We can pay off excess capital, also quite rare. But this third one, guys, this is it. This is the one you absolutely have to know inside and out for your exams. It's canceling the paid-up capital that has been lost or isn't backed by any real assets. This is where the shareholders take a hit. They make a sacrifice to save their company. And when that capital is sacrificed, where does the value go? It goes into a brand new, special, temporary account. We call it the capital reduction account, or sometimes the reconstruction account. I want you to think of this as the central collection pot, the company's turnaround fund. Every sacrifice made by shareholders and anyone else gets pooled right here, getting ready to be used. So what exactly flows into this account? Well, the main source, the big one, is the sacrifice from shareholders when we reduce their capital. But others can chip in too.
Creditors might agree to forgive part of their debt. If we revalue an asset upwards, say a piece of land is worth more now, that gain goes in. If we sell an investment and make a profit, that goes in too. Basically, any financial win during this whole process gets credited to the capital reduction account.
Okay, so we filled up our fund. Now, what do we spend it on? We use it to go on a cleaning spree. We debit the capital reduction account to finally write off that horrible accumulated loss in the P&L. We get rid of worthless goodwill and patents. We write down inventory that's overvalued and create a proper provision for bad debts. After all this cleaning is done, and listen up, this is a crucial point that so many students forget, if there is any money left over in the capital reduction account, it must be transferred to the capital reserve. Don't forget that.
All right, theory's one thing, but ICII loves to test your application skills. So let's walk through a proper exam-style case study and see how all these moving parts come together. First up, let's see how the company gathers money for its capital reduction account. The shareholders are making some big sacrifices here. Preference shares are being written down by 25 rupees each, and equity shares are getting slashed by 8 rupees each. Then a property is revalued upwards, that adds to the fund. An investment is sold at a profit, more for the fund. And look, even the directors are waiving a part of their loan. Every single one of these actions is a credit into our turnaround fund. So how does this look in the journal? Don't get overwhelmed. We simply debit the old share capital accounts for their full face value, and then we credit the new share capital accounts for their new reduced value. And the difference between those two, the part that was sacrificed, boom, that gets credited straight to the capital reduction account. All the other gains, like the profit on selling investments, also get credited right here, building up our fund.
Now let's put that fund to good use. The reconstruction scheme lays it all out for us. We have to write off the goodwill and patents completely. The inventory needs to be written down to its real value. We need to create a necessary provision for bad debts, and of course, the big one, that huge debit balance in the P&L account is finally wiped off the books. Even a penalty for canceling a contract gets paid out of this fund.
The journal entry for all this is actually pretty simple. It's just one big debit to the capital reduction account, using up all that money we collected. And on the credit side, we're just listing all the junk we're thrown out. Goodwill, patents, the P&L account, we're reducing inventory and creating the new provision. And just like that, the balance sheet is finally cleansed of all its old baggage. Okay, let's look at one more variation, because ICAI loves to add little twists. In this case of Rebuilt Limited, notice the different things going on. The lenders are converting their loan directly into shares. This is a really common move in real-world restructurings, and definitely a favorite of ICAI, this whole debt-for-equity swap. But the core process, it's exactly the same. Gather the sacrifices into the capital reduction account, and then use that fund to write off all the losses.
So the accounting's done, the balance sheet looks fresh and clean, we're finished, right? Not quite. There are a couple of super important compliance steps that can cost you some very easy marks if you forget them. First, if the court says so, the company must add the words "and reduced" to its name. It's like a public notice that a capital reduction has happened. Second, and this is a key point for presentation marks, the amount that the fixed assets were reduced by has to be disclosed in the notes to the balance sheet for the next 5 years. Please do not forget this in your exam. It's easy marks. So when you boil it all down, internal reconstruction isn't really about complex journal entries. It's a 3-step story of corporate survival. First, the stakeholders have to sacrifice to create that turnaround fund. Second, that fund is used to cleanse the balance sheet of all the junk from the past. And finally, with a clean slate, the company gets a chance to rebuild a profitable future. Just remember those 3 words: sacrifice, cleanse, rebuild, and you'll be ready to tackle any reconstruction problem the exam can throw at you. So picture this. You're in the exam hall, you've balanced the capital reduction account perfectly, you're feeling great, but then you realize you missed that one tiny tricky adjustment about a contingent liability. That could cost you 5 or 6 marks, just like that. These are the classic traps ICAI loves to set, and today we're going to learn how to spot and handle every single one of them. All right, it's time to roll up our sleeves and get into the accounting. Let's move to Section 2 and see how these entries work using Illustration 5 from the ICAI material, the case of Vaibhav Limited. I promise you, if you master these fundamental entries, you've basically mastered half the chapter. So let's take a look at the case of Vaibhav Limited. We've got a whole list of things to do here. We need to reduce the share capital, work out a deal with debenture holders and creditors, and write down some overvalued assets. Our job is to pass all the journal entries and then prepare a brand new, clean balance sheet.
First up, the share capital reduction. It's a simple 3-step process. Step 1. Debit the old share capital account to get its full value off the books. Step 2. Credit the new share capital account with its new reduced value. And step 3, which is the most important part, the difference, the amount that shareholders have sacrificed, goes into a special temporary account. Let's call it our magic pot, the capital reduction account. This account is the heart of the whole process. It's where we collect all the sacrifices.
Now, let's look at the liabilities. The 5% debenture holders agreed to a new deal that's worth less than what they were owed. That difference, that 24 lakhs they gave up, you guessed it, straight to the credit of our magic pot, the capital reduction account. Same thing with a creditor who waives 16 lakhs of his claim. That sacrifice also gets credited. You see the pattern here, right? Any sacrifice made by anyone, shareholders or creditors, is a contribution to this reconstruction fund we're building.
Okay, so we filled up our reconstruction fund. Now it's time to use it. We debit the capital reduction account to write off all the junk on our balance sheet. The debit balance in the P&L, the overvaluation in our assets, everything. We're literally cleaning the slate. But hang on, what happens if we have some money left over in the fund after we're done cleaning up? Where does that leftover balance go?
It goes straight to the capital reserve. And listen, this is a non-negotiable rule. The balance in the capital reduction account is a capital profit, so it must be transferred to capital reserve. This is a super important checkpoint in your answer. If your account doesn't tally and you miss this, that's exactly where you lose easy marks in the exam.
Okay, so we've got the basics down pat. Now, let's level up. Welcome to Section 3, Settlements, Swaps, and Surrenders. This is where IKAI starts to get a little more creative with how liabilities are handled, and we'll see this in illustrations 6 and 7.
Now check out the twist in illustration 6. Instead of just reducing the amount the company owes, the company is actually settling its debts by giving away its assets. You've got debenture holders taking over machinery and trade payables taking inventory. This is a classic ICII adjustment, so you'll want to pay very close attention to how this works. Let's break down the logic here. Let's say a creditor is owed 100 rupees. We give them an asset from our books that's worth 80 rupees, and we call it even, full settlement. So the liability of 100 is now gone. The asset of 80 is also gone. The difference, that 20 rupees, is a gain for us, right? So where does it go? Straight into the capital reduction account. It's really that simple. Now just apply that same logic to the numbers you see on screen. It's the exact same principle.
Now let's talk about another really unique technique from illustration 7, share surrender. This is different. This isn't just about reducing the face value of a share on paper. No. Here, shareholders are physically giving back a portion of their shares to the company. The company can then use these surrendered shares almost like a currency to pay off its debts. They're basically funding the rescue with their own shares.
So here's how that process works. First, the shares might be broken down into smaller denominations to make them easier to handle. Then, the shareholders surrender a percentage of their shares into a temporary account called the share surrender account. The company can then dip into this pool of surrendered shares to pay off its creditors. And whatever shares are left over in that pool at the very end, they get canceled. And their value becomes a gain for the company, which gets transferred to our reconstruction account. All right, you ready? It is time for the boss level, Section 4, Advanced Exam Adjustments. Here we're going to look at illustration 8, Recover Limited. And this problem, it combines multiple complex adjustments, which is exactly what you can expect in a full 16-mark question in your exam. This problem is just loaded with ICAI's favorite curveballs. We've got unrecorded liabilities like preference dividend arrears being settled. We've got complex asset swaps where cash actually comes back into the company. And yes, we've got that contingent liability adjustment we talked about right at the start. Nailing these details is what will make your answer stand out. Okay, let's carefully break down this debenture settlement entry. First, the total amount due to the debenture holders, including interest, was $55,000. Second, they took a property that was valued at $75,000, so they actually owed us money. They paid the company back the difference of $20,000, which is why you see bank account being debited. Third, the property's book value was $120,000, but we settled with it for $75,000, so we made a loss of $45,000 on this deal, which we have to debit to the reconstruction account. It looks tricky, but when you break it down into pieces, it makes perfect sense. Okay, wow. We've just worked through some pretty intense practical problems. So let's take a breath, switch gears in Section 5, and decode the theory. And you'll see, now that you've seen the entries in action, the rules are going to make so much more sense. This little table you see on screen, this is pure gold for your MCQs. It's so important. Not every change to share capital is a reduction that uses the capital reduction account. For example,
A simple alteration, like splitting 100 rupee share into 10 10 rupee shares, that doesn't involve any sacrifice. The capital reduction account only comes into play when there's a genuine financial sacrifice, like a reduction in the paid-up value, a waiver from creditors, or a surrender of shares. That's a crucial distinction to remember.
We are in the home stretch now. Let's head into our final section and test what we've learned with some quick-fire exam-style questions. You ready for this?
Okay, let's knock these out. Number 1, reorganizing capital without shutting down the company is, of course, internal reconstruction. Number 2, accumulated losses are written off against the capital reduction account. That's its main job. And number 3, a formal reduction of share capital needs permission from the court or tribunal. And why is that? Because reducing capital can affect the rights of creditors, so it needs legal approval.
And that pretty much brings us to the end. So if there's one thing to take away, it's this. You create a reconstruction fund. You gather all the sacrifices from shareholders and creditors. You use that fund to completely clean the balance sheet of all its junk. And then, whatever good news is left over, that balance must go to the capital reserve. If you remember that final rule, you will have the perfect ending for your reconstruction answer. Keep practicing, and you are going to ace this chapter.